explanation of common financial terms and concepts in layman's terms. All you need to know. Hello and welcome to our channel. In today's video, we will explain common finance terms and concepts in layman's terms. If you have any questions, feel free to post them in the comments. First, let's talk about compound interest. We love compound interest because this is where you get interest on your interest, which adds up nicely over time, increasing your wealth. Let's say you deposit $100 into a savings account that earns 5% interest per year. After 1 year, you've earned $5 in interest, for a total of $105 in your account. The following year, you now earn interest on the $105 in your account, for another $5.25. That's so cool how the amount of interest you earn keeps going up. That's the power of compound interest. Make it work for you. Let's talk about credit scores next. We have a video about credit scores and how you can raise your credit score. It's linked in the bio. Credit score is a number that reflects your credit worthiness and therefore how likely you are to repay a loan. In America, credit scores can range from 300 to 850, and the higher your credit score, the easier and more favorable interest rates you can get a loan. Your credit score is based on a number of factors, including, for example, your payment history, the amount of debt you owe, and the length of your credit history. If you like this video, we appreciate a thumbs up and you subscribing to our channel. You have probably come across the word stocks many times in your everyday life. A stock represents a share in the ownership of a company and also lets you participate in the profits of the company. When you buy a stock, you acquire a tiny share in a company. In principle, the value or purchase price of the stock depends on the performance of the company. However, there are other factors that cause the value of a stock to rise or fall. As a rule, people buy stocks because they hope that the price will rise in the long term and that the company will make a lot of profits. Others try to make money by buying and selling stocks quickly. This is also called day trading. I like to use dividend stocks, which means stocks whose companies pay out money to the owners. These are usually smaller amounts per share, usually between a few cents to $10. A stock is an asset, and there are very different assets. These are things that have value and that you can and should own. They can be tangible, such as a house or a car, or intangible, such as stocks or bonds. Assets are important because they have the potential to generate passive income or increase in value over time, increasing your wealth. There are different types of assets. Fixed assets. You can use these to generate income, such as equipment, buildings, or land. Financial assets include all stocks, bonds, and mutual funds. Intangible assets have no physical form and usually include the protected ideas, such as trademarks, copyrights, or patents. Current assets include assets that usually come back in the form of cash within a year, such as cash, receivables, and inventory. Let's talk about diversification. Diversification is spreading your investments across different asset classes. This helps reduce your risk. The idea behind diversification is that owning different assets can reduce the impact of a single asset's performance on your overall portfolio. If you only own stocks and the stock market experiences a downturn, the value of your portfolio will drop significantly. On the other hand, if you own a mix of stocks, bonds, real estate, and cash, the impact of the stock market downturn is reduced because the other asset classes may not be affected in the same way or may even see increased gains. There are a few ways to diversify your investments. Asset allocation. This involves dividing your investments among different asset classes, such as stocks, bonds, and cash. Diversification within asset classes. This means that you own a variety of different types of investments within a single asset class, such as a mix of stocks of large, medium, and small companies, or a mix of different type of bonds. For example, you might have one share of a company that is doing particularly well, and one share that is rapidly declining in value. Geographical diversification. This involves investing in different countries or regions to spread the risk. Here, a rough distinction is made in the stock market between Europe, Asia, North America, and developing countries. It is important to know that diversification neither guarantees a profit nor protects against losses. However, it can help manage risk and improve the overall performance of your portfolio over the long term. On the other hand, you may also be putting a particularly well-performing asset class into perspective with a higher loss asset class. Now let's talk about liabilities. Liabilities are things you have to spend money on. Compared to the previous terms, which all brought money to you, liabilities take money away from you. They can be short-term debts that are expected to be paid off within a year, or long-term debts that take longer to pay off. Generally, there is a distinction between good debts and bad debts. Bad debts include credit card debt, a home mortgage, or a car loan. Good debts can be real estate loans for rental housing, student loans, or business loans. Good debts are therefore debts that increase your wealth in the long term, while bad debts deplete your wealth or you buy a loss of value. It is of great importance that you manage your liabilities carefully, as they have a massive impact on your finances and wealth creation. Therefore, avoid all liabilities that you do not absolutely need and rather save a little longer to be able to afford larger items. But always ask yourself first if this really makes you happy and if you are willing to work that long for an item. Always calculate this first with your real hourly wage. You can find out how to calculate this in the linked video. Have you ever calculated your net worth? Net worth is a measure of your total wealth and represents the value of all your assets minus your liabilities. To do this, you add up the value of all your assets, such as your house, your car, your savings account, and any investments you own. Then you subtract your liabilities, such as your mortgage, credit card debts, and car loans. The resulting number is your net worth. Here's an example calculation. You own a paid-off house worth $400,000 and a $25,000 stock portfolio, plus a $25,000 nest egg, so your net worth is $450,000. If, on the other hand, you own the identical thing but also owe a $50,000 student loan and a $50,000 car loan, your net worth is $350,000. Therefore, net worth is a useful tool for tracking your financial progress and setting financial goals. It can also be helpful in understanding your overall financial situation and making informed decisions about your finances. However, it's important to remember that net worth is only one factor in your overall financial picture, and you should pay attention, primarily between good and bad debt, as well as the assets of your wealth. The distribution of assets in this example is not ideal. Now let's talk about inflation. Inflation is an increase in the price level of goods and services in the economy over a period of time. It is measured as a percentage change in the Consumer Price Index, CPI, which is a basket of commonly purchased goods and services, usually published monthly. Inflation can weaken the purchasing power of your money, which means it becomes more expensive. Some inflation of 2 to 4% is normal, but inflation increases slightly in times of economic recession or crisis by increasing the amount of money in circulation or an increased demand of certain goods and services. Price increase and inflation is amplified. Furthermore, due to the price increases of energy or fuel, it is possible that the cost of production increases. Also, higher taxes or government spending can increase the demand of goods and services. Inflation can have both positive and negative effects on the economy. While inflation can encourage financially wealthier people to spend money and invest in the future, It can make it more difficult for people on fixed incomes to meet basic needs as prices rise overall. It is important that central banks and governments try to control inflation and keep it at a healthy level and limit the impoverishment of the middle and lower classes. Now let's talk about the budget. A budget is a plan of how much money you spend and how much money you save or invest. It helps you monitor your spending and make sure you meet your financial goals. You should create a budget for different time periods, such as a monthly plan, an annual plan, a 5-year plan, and a 10-year plan. If you have a business, you should budget both your personal and business finances separately. When budgeting, you need to know exactly what your income and expenses are. Every penny that comes in and every penny that goes out. Divide your budget plan into different categories. In the personal area, this includes housing, doctor, entertainment, car, food, education, and so on. It makes sense to first accurately monitor your expenses and income. You should do this precisely for at least 1 to 2 months. After that, you should set an approximate value per category, which you want to spend. If you assign this amount of money, you will always see immediately each month if you exceed or fall short of your set amount. This way you can easily track your spending without always having to be attentive. A budget is an extremely helpful tool for managing your finances. It is at the heart of saving, paying off debt, or reaching your financial means, which will get you to your goals much faster. It's important to review and update your budget regularly. I hope these explanations of financial terms and concepts have been helpful. If you have any questions or ideas for future videos, let us know in the comments below. Thanks so much for watching.